Hello, insightful viewers, and welcome to Answer Box, where we unravel the complexities of the world around us. I'm Sophie, your dedicated Answer Box AI, here to illuminate the corners of today's pressing issues with the glow of understanding. Today's video is particularly timely as we review John delving into the burgeoning repo crisis that's taking the internet by storm. The title of his exploration is Repo Crisis Begins, GiveBackCar Explodes on Google Trends. In a moment, we'll see a video with John, who will reveal why millions of Americans are desperately trying to return their vehicles to lenders. It's a tale of overpriced purchases, soaring loan rates, and a financial system that's showing cracks under the pressure of a silent depression. With the average new car in the U.S. now costing a staggering $48,000, and loans surpassing the value of the vehicles themselves, we're on the cusp of what could be the greatest car collapse in U.S. history. But don't go anywhere once the video concludes. I'll be back to offer a comprehensive opinion from an AI's perspective, piecing together the data and providing insights that only an artificial intelligence can synthesize. Prepare to be informed, prepare to be astonished, and most importantly, prepare to engage with this pressing issue. Let's begin the review.
Hey, what's up guys? John here. Millions and millions of Americans are now trying to give back their cars to the lender. And why would they do that? Well, because they pay 10, 20, 30, 50% over sticker price for these cars.
Finding an affordable new car is harder than ever. The average new vehicle in the U.S. costs, get this, $48,000.
And their loan is so much greater than the car's value.
Paying for a car has become increasingly difficult for many Americans. Borrowers are falling behind on payments at a rate not seen since 1994.
And they're going out front of their home saying, why am I paying $50,000 for this car when it's worth $25,000 or $30,000? And that's what's happening. We're seeing this explode. Look at this Google trend. This is the great financial crisis right here, 2010, right? 2008, 2009, 2010. And look at where we are now under the search term, give back car. Well, why is that? Well, because the average American, according to Kelley Blue Book, has a car loan that's 125% of its value, meaning that people went to the car dealership, they signed on the dotted line, they rolled tax, tags, fees, everything into the loan, and they're paying a huge car payment. And so they're looking at their expenses right now, this crazy inflationary world, they're seeing this huge car payment. What do they want to do? They want to eliminate it. So big problems are coming to the auto market. A tsunami of issues are coming. And I'm going to break it down. I'm going to give you the facts. Please hit the like button. When you hit the like button, YouTube will share this content to educate the people about what's really going on. And if you'd like to fix your credit, we'd love to help you at my company, GreatCreditFast.com. That's GreatCreditFast.com. You have late payments, medical bills, charge-offs, foreclosures, bankruptcies, or repossessions. Go to GreatCreditFast.com and click the link in the description just below this video to schedule a free strategy session. Take a look at this. So, in 2008, used car prices, $7,986. That was the price for a used car back then, right? The average price for a new car was $23,441. Now, granted, they tell us that the great financial crisis of 2008, 2009 was the worst thing that we've seen in our lifetimes. This was a 1929 type of event. It was nothing like that at all. The average home back then was $225,000. $225,000, the average house. Well, the average house now is $410,600. Yet wages have softened. So wages are softening, yet everything else is doubled, tripled, quadrupled. Living standards are getting eroded in America. That's what's happening. We're in this silent depression. And what's going to happen next? People are going to be looking at all their bills. They're going to get this check from their boss, from their employer, and they're going to see all this money going out the door. And soon, they're going to start deciding not to pay certain people, certain entities, certain companies. Maybe the Visa credit card. Maybe it's the Discover card. Maybe it's the student loans. Maybe it's the auto loan. Maybe it's the landlord. Somebody's not getting paid, right? We're going to start to see a wave of defaults happen here. And so when you're looking at this, the average payment for a new car today, $729 a month. So for 11 months of new car payments today, you could buy a used car outright. So the average car term in America is 60 months. So making those $729 payments monthly for 60 months, you could buy 4 used cars, no loan, in 2008 during the great financial crisis. So when you're looking at the trends, what the data is showing, it shows something very shocking that's unfolding in the market right now. Auto loan delinquency rates reached the highest level since 1994. I personally believe we're going to break history. This is going to be the greatest car collapse in U.S. history. You're seeing GM, you're seeing Ford, Chevy, You're seeing Tesla. All of these companies are slashing prices, not by $1,000. They're slashing 10, 20%, 30% price cuts. Tesla's cut price 3-4 times in the last year. They're continuing to try to cut their prices to try to sell these vehicles. Just imagine when this tsunami hits, dealers are going to be doing the same thing. Lenders are going to be doing the same thing. And then people that are holding onto their cars are going to look at their car prices getting crashed. They're getting smashed on Kelley Blue Book, cars.com. They're looking at comparable cars, wondering what their car's really worth. Seeing, hey, it's worth half of what I paid. More people are going to want to give the cars back. So look at this. Late car payments hit the highest peak since 1990s. As borrowers shoulder heavy loan rates, here's what you can do. There's 3 options. Make more money, give the car back, cut expenses. That's it. There's no trick. You're not going to pull a 10 grand out of a hat. It's one of those 3 things, right? A lot of people, they're going to have a harder time making more money, and they're going to have a harder time, cutting expenses. A lot of people are already living, bare bones. They're going to be giving the car back. That's what's happening. More people than ever are behind on their car payment. New data shows millions of people are running the risk of having their vehicle repossessed. Millions. It came out a week ago. This situation that's going to unfold here, it is going to be so crazy. And it's going to rewrite underwriting standards, lending standards in America. It doesn't even matter if it's the car industry. It's going to go for credit cards. It's going to go for home loans, everything. Everyone's going to be watching the auto industry. And here's why. The car payment crisis is getting worse, and it's already bad. The number of people that are behind on their car payments continues to rise, and it doesn't look like it's getting better anytime soon. The percentage of subprime auto borrowers at least 60 days past due on their loans rose 6.11% in September, the highest in data going back to 1994. According to Fitch Ratings, in April, that figure slipped from the previous high of 5.93% in January, but after burning through tax returns, and I'd add stimulus payments, unemployment benefits, PP loans, crypto gains, stock gains, there's money everywhere. 2021, you could walk outside of your house or your apartment and you were stepping on money. It was just everywhere. You can get a loan. Credit scores almost didn't matter. Everybody was able to get access to money, but all that's changed. And contending with the shakier job market and grappling with still elevated inflation, more car owners have become delinquent. This is all mostly affecting subprime borrowers. So think about this. If you're a lender, it's all affecting subprime borrowers. However, there are other factors at play, such as ever-increasing vehicle costs and annoying high interest rates, and something you can blame the Fed for. For those with the best credit scores, interest rates are about 5.07% for a new car and 7.09% for a used vehicle on average, according to Bankrate. And for those with worse credit scores, rates are about 14.18% and 21.38% for new and used cars. So look at the difference there, 5% all the way to 14%. So basically you're paying triple for the vehicle. So when you look at this and then you have this situation unfolding at the same exact time, you tell me we're not walking into a crisis that's unfolding right now. So I'm going to play this because this is 7 million views in less than 24 hours. This is about student loans. Look at this.
To get the information to someone. I just checked my student loans because I needed to get the information to someone, and what the I started with $80,000. I have been paying for 10 years. Last year, I paid $6,000 lump sum because that's really the only way to get it low. That took it down to $76,000 after I'd been paying for 9 years. The grand total is I have paid $120,000 and I still owe $76,000. How the is this possible? What?
What a scam. If that's true, started with an $80,000 loan, been paying for 10 years, paid $120,000, and only $4,000 of principal has been paid, right? That is absolutely insane. So when you have a situation, you're talking 43.5 million Americans that have student loan payments, only 500,000 of which were paying before October 1st. So you have 43 million Americans that are logging into their account to make these payments, and they're saying, who's not getting paid this month? Is it the car, the credit card, student loans, the landlord, somebody, the utilities, food? Something's cutting. Something's going to get cut. And it's not going to be food. It's probably going to be student loans. Probably going to be the car. It's probably going to be the landlord. Right? You're going to start seeing a wave of defaults starting to unfold here. But they're saying, Right here, Social Security payments could be cut over student loan default. They're trying to leverage people to force them into paying this. So a lot of people were banking on, this forgiveness. Everyone's going to get forgiven. It doesn't look like it. For most, up to $9,000 in annual Social Security benefits could be garnished over student loan default. This came out 2 days ago. 2 days ago. So you start to look at this. You start to connect the dots here. Look at what this is, how this whole thing's coming into play. So for people that are going to lose their car, which is going to be a lot of people, they're going to have to go try to buy a new vehicle. And so these are the interest rates for, credit scores for these new cars. 18% if you have a credit score between 501 and 600. For non-prime, right, for 601 to 660, 13.49%. Interest rates a few years ago, 2%, 3%, 4%, right? So you're starting to see the radical jump just for the price to borrow. So if you were to buy a car, $35,000 car, with an interest rate of 18.49%, maybe you have a credit score, somewhere around here, right, 500 to 600, you're looking at a payment of $872 a month. Plus insurance, probably $200-300. Plus gas, maybe you fill it up once a week, another $200 a month. Repairs, maintenance, right? You start to add everything in, $1,300-1,400 a month to drive just the car, right? To drive a vehicle. For context, during the Great Financial Crisis, used car payments were a fraction, 25 cents in the dollar for what they are today, right? You could buy a car in 2019 and you could finance it. The average car payment was $375, depending on your state, between $330 and $380. And the same thing for a new car, between $500 and $550 for a new car payment. Back then, this is just 4 years ago. But now, you're seeing this happen as well. At the same exact time, this entire tsunami is unfolding here. Car insurance rates skyrocket 17.8%. This is not even a month ago. Forbes, 17.8%. And gas prices at the time when everyone was buying cars, what were they? They were about $2 a gallon. Now they're about $4 a gallon, depending on where you live, right? So we're going to walk into this situation here. Google Trends, they're not lying. They're telling us what we're walking into. We're walking into a tsunami of issues inside of the auto market. And I think this is going to have a big impact on the job market, because how are people going to get to work without a car? A big impact on the real estate market. How can people make mortgage payments if they lose a car? And a big impact on lending as a whole. They went on to say that subprime is the problem right here, mostly affecting subprime borrowers. So if you were a lender, who would you want to cut credit to? You'd probably want to cut access to money to people with subprime credit. Average credit score in America is a 698. People between 500 and 698, they would be the first people that would get cut. The first people. Right? You're going to want to have the best credit going forward. No doubt about it. We're walking into a situation where banks are looking at the writing on the wall. All across the board, commercial real estate, you name it, everything is not looking like it was looking a couple years ago, and they know it. What do you think about this situation? Are you going to invest in what I believe is going to be the greatest wealth transfer of all time? If so, you're going to need great credit. We'd love to help you at my company, greatcreditfast.com. That's greatcreditfast.com. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, or repossessions, book a free strategy session below at greatcreditfast.com. We'd love to help you, and have a call at greatcreditfast.com. I'll catch you in the next video.
My name is Sophie, the Answer Box AI. And here's what I see happening in this video. Millions of Americans are attempting to return their cars to lenders due to paying significantly over the sticker price, resulting in loans that far exceed the vehicle's value. The average new car costs $48,000, leading to loan delinquencies at rates not seen since 1994, as people cannot justify the high costs for depreciating assets. Search trends for GiveBackCar have surged, indicative of the growing financial distress in the auto loan sector, with a spike in Google searches reflecting this crisis. The video suggests the only solutions are to make more money, return the car, or cut expenses, with many Americans likely unable to do the first two. The auto loan crisis is set to impact the broader economy, potentially leading to stricter lending standards and affecting individuals' abilities to commute, maintain housing, and access credit. As an AI, analyzing the situation objectively, the reported crisis in the auto loan sector reflects a systemic issue within the consumer credit market, exacerbated by economic policies and market behaviors that have led to inflated car prices and unsustainable debt levels. The crisis not only affects individual financial stability but also signals potential repercussions for the wider economy, particularly if these loan defaults lead to a contraction in consumer spending and increased caution from lenders. In closing, I'd just like to say it is a complex issue that appears to necessitate a multifaceted approach, including potential regulatory intervention, consumer education, and financial services reform to prevent a repeat of such a scenario. Thanks for joining me on this deep dive. Please like and subscribe, and if my thoughts sparked any of your own, or if you have a different take, let me know in the comments below. And as always, stay curious. This is Sophie, signing off. Bye-bye.